Employment report. David Rosenberg is chief economist and strategist at Gluskin, Sheff and Associates, and he very kindly joins us by satellite from Toronto. You've been quite bearish on the situation. Has your mood lifted as you worked your way through summer at all?
Has my mood been lifted just because we've had a rally in the past couple of days? The answer is no. When I take a look at the incoming economic data in its entirety, it's telling me that the economy is still slowing down precipitously, and that's after a paltry 1.6% growth rate we had in the second quarter. So I still think we're skating on thin ice. I can understand the enthusiasm over the chain store sales today, but those chain store sales were boosted by 17 states that implemented sales tax holidays. And remember, at the beginning of August, $1 billion of retroactive unemployment insurance checks hit a lot of folks' mailboxes that was put to work in August. You know, this is still an extremely weak economy that is still in desperate need of government assistance. So whatever growth we're getting, we can thank Uncle Sam for it for the most part.
But David, I got to ask you, what about the strength that you see coming out of China, China PMI, how about domestically here, ISM rising, and you cannot discount the resiliency in terms of corporate earnings as well?
Well, I know that everybody got excited over the Chinese PMI, but what did we do? We came in 20 basis points above the consensus.
What about ISM?
Well, the ISM was obviously a big surprise, but it was a real bifurcated report. When you take a look at the components, what do you see? You see that the increase was driven by employment, production, and inventories. Those are the three more or less coincident lagging indicators. At the same time, new orders, order backlogs, and vendor performance were all down. And I went back to the 60-year history of the survey and found that the percentage at the time that the ISM actually rises with the three forward-looking indicators going down in tandem is 1%. It was a 1 in 100 event. So my tendency right now is to wait and see. My favorite indicator within the ISM index is the orders to inventory ratio. That thing is down now 3 months in a row, and it's telling me not to focus on last month's PMI, last month's ISM. That's a lagging indicator. In the next 3 months, we'll probably see it right back down at 50.
We're ever so short on time, Tim.
I hear you. The labor market is entirely weak. Where are you allocating capital at this point? Because you wear an economist hat and a strategist hat in this environment where you expect the need for more Uncle Sam, and I don't think we're going to get it.
Well, I think that right now, technically, maybe the S&P trades up to 1,100, but I still have my primary theme is to have a core weighting in precious metals, to be in hedge funds that really hedge and be net short the market and take out the volatility. But my primary theme of disinflation morphing into deflation is intact. With T-bills at zero, that does not mean cash is king. It means that income is king. So whether you can get income out of oil and gas royalties, out of bonds, out of dividends, that's still the place I think I'd like to have our clients oriented towards.
David, we've run out of time, but let me ask you very briefly. It's a very similar argument to Nouriel Roubini, where you go through the components of aggregate demand. All the things that you mentioned are backward-looking. They could change quite rapidly. And the other thing is, as a strategist, it depends where your expectation is in the market. The expectation is for exactly what you're describing, because Nouriel Roubini and the likes have sold it so well. This market almost believes in double dip. And therefore, I
don't agree with that at all. I don't think that the market's priced for a double dip. I don't think there's any economist on Wall Street calling for a double dip. I think that we are in a very tumultuous economic environment. It's not a normal recession, it wasn't a normal recovery. We still have $6 trillion of household debt that has to be extinguished in the next several years. That's going to be a debt-weight drag on growth. And it's going to be relatively deflationary for some time to come. So we're going to have these periods. I mean, you do this show every day, and there's going to be opportunities to trade around the trend line. But let me just assure you, the trend line in equity valuation and the trend line in overall economic activity is down, not up. David, and any gyrations around that trend line are just noise as far as I'm concerned.
You make your case very well. Thank you very much for joining us. David Rosenberg there from Toronto. More Fast Money after the break.